Good afternoon once again, my ECO 3311 students. I recorded the first part of chapter 14, which is a money creation process, and we derived the formula for the simple money creation deposit creation process. But we left when I was about to start doing an example. So I'm gonna pick up from where we stopped. We finished this chapter today. Okay, so let me share my screen, then we talk about it on the other side. This is not what I want to share. Stop sharing. Let's see. It's one moment. There you go. Okay, so I'm just gonna dive straight to where we stop. I'm not gonna repeat this again. So we went through all these balance sheet entries: Federal Reserve, the central bank balance sheet. So this is where we stop. We finally derived this model. So make sure you watch the first part of this recording, which I did it first, and we derived this formula for the simple deposit multiplier. This simple model based on the assumption that banks keep no excess reserves, remember, and the public hold no cash. So we were supposed to do an example, but then the video was going to be too long, so I had to chop this into two parts. Okay, so let me open a new slide, then we are going to do an example on this. Okay. So let's do an example. So let's say suppose the Federal Reserve, purchase $50 million securities or bonds from banks. And part A, I'm going to ask you to show using balance sheets the impact of this bond purchase on reserves and monetary base. So we've been doing this over and over again. Monetary base. And then B, if the required reserve ratio, the reserve ratio is, say, 20%, what would be the size of the simple deposit multiplier? Then see how will deposit in the banking system be impacted. Then lastly, what is the impact on money supply of this bond purchase? What is the impact on money supply. Okay, so it's pretty straightforward. So let's go to the next slide and talk about it. So we've been told that the Federal Reserve purchased $50 million worth of bonds from banks, and they want us to show the impact of this bond purchase on the balance sheet of the Federal Reserve and the balance sheet of banks, of the banking system. So this is a banking system. And then the balance sheet of the Federal Reserve, put it side by side there. So the Fed purchased securities worth $50 million. When you buy something, you gain it. So there's a plus $50 million here, but they're buying this from banks. That's what the question says. So banks are the ones selling in this time. When you sell something, you lose it. So that's going to be minus $50 million. Okay. But the Fed is going to pay for this by crediting the bank's reserve account. So banks are going to see their reserves. Reserves are bank assets. Go up by $50 million. So there's plus $50 million. That's how the Fed is going to pay for those securities. While reserves are the bank asset, they're the Federal Reserve liability. Reserves is going to be plus $50 million. Okay, remember the left-hand side of this balance sheet is assets, right is liability. Same thing, assets, liability. You know that. I don't want to write clear. You know what it is. Okay, so now we know that the change, because the question say we should show using a balance sheet of reserves and monetary based change. So the change in reserve is going to be $50 million based on that balance sheet. And then we know that the change in the monetary base can come from change in currency or from change in reserves. In this case, it's a reserve component that is changing by $50 million. Therefore, the change in the monetary base is going to be $50 million as well. Okay? And then part B says, if the required reserve ratio is 20%, what would be the size of the simple deposit multiplier? Okay, so that's B. We know that the formula for simple deposit multiplier is very simple. Simple deposit multiplier equals to 1 over R. So if the reserve requirement ratio is 20%, remember R has been given us 20%. 20% is the same thing as 0.2. So it's going to be 1 divided by 0.2. Okay, so that means this is going to be 5. So the interpretation here is that for every $1 deposit made in a bank, or for every $1 bond purchase that, by the Federal Reserve, which triggers an increase in monetary base or reserve of $1, deposit in the banking system is going to increase by $5. For every $1 bond purchase by the Federal Reserve result into an increase in deposit by $5. Okay, so then we can go now and and calculate the change in the total deposit in the banking system. Okay, so let's open a new slide once more and talk about it. Okay, so okay. So part C, they're asking us to figure out what the change in deposit is. So we know the formula delta. Delta means change. Change in deposit, we know the formula is given as change in reserves as a result of that bond purchase divide times 1 over R. We derived this formula already. So delta D is going to be equals to, we know when the Fed purchased bonds, we saw that already. That reserves are going to change by $50 million. So change in reserve here is going to be $50 million multiplied by 1 over 0.2. So delta D is going to be equal to $50 million times 1 over 0.2 again is 5. So deposit in the banking system is going to change by $250 million, by 5 times as much. That's what this means. Because for every $1 bond purchase by the Fed, deposit go up by $5. What about for $50 million? That means it's going to go by 5 times, 50 times 5, 250 million. And then D, we learned from chapter 3 that money supply, which is M1, is a sum of currency plus deposit plus traveler's checks. But for now, we're going to assume that traveler's checks are a negligible component of M1. So nobody uses traveler's check anymore. So the money supply is just going to be the total sum of currency in circulation and the total size of deposit. So if we get the change in the money supply M1, this is brought about, can be brought about by change in what? In currency plus change in deposit. So it's a deposit that has changed by $250 million, meaning that the money supply will also go up by what? $250 million. There you go. Straightforward. So that's how you approach this problem. Now, just for heads up, suppose the question that says, suppose the Federal Reserve had sold bonds, if they had sold, not purchased, then everything that I talked about here with the sign, the numbers would be the same, but the signs would change. Because when the Fed sells bonds instead of buying bonds, and you're supposed to show, that means if the Fed is the one buying, this is going to be negative $50 million on the Fed, you have the securities of the Fed. Banks will be the ones buying. So this would be $50 million positive. And then the banks would pay using their reserves. This would debit the bank's reserve, negative 50 million. So the change in reserves here would be negative 50 million for bond sale by the Fed. And then the change in the monetary base will also be negative 50 million, okay? And then we apply that because change in reserve is negative $50 million. We put a negative sign here. So deposit in the banking system would decrease by $250 million. It would be negative 250. And the change in the money supply would also go down by 250 million. That's exactly what we tell you in principles of macro, that anytime the Fed purchases bonds, money supply goes up. But when they sell bond, money supply decreases. Okay? And then sometimes I may also I may be tricky. So once you really know this formula here, especially this the last formula, this guy here, once you know this, sometimes I may ask you a question, it might be a little tricky. I would say, if the goal of the Fed is to increase total deposit or money supply by $250 million, okay? If the required reserve ratio is 20%, what specific monetary policy action or bond purchase is required to achieve that goal? So in that case, I would have given you change in that deposit, and I've given you little r 20%, which is 0.2. So you'd be solving for what? Change in results. Because remember, every bond purchase result into an equal amount of change in the what? In reserves. So that means you would be solving for what? The specific policy action would be the Fed would be purchasing $50 million. You'd solve because you're going to put 250 here equals to change in R, then 1 over 0.2, then solve for the unknown. Basically cross multiplying 0.2 both sides. You get $50 million in that case. So it's not too bad. What are the main critique of this simple model? The simple model rests on 2 primary assumptions. The first assumption is that banks all know what? Excess reserve, meaning that if banks all reserves, all some excess reserve, the simple model is going to break down. We're not going to get a complete money creation process. The system is going to break down if banks choose to start holding reserves. And then the system also assumes that the model assumes that what? The public hold no cash. It's a cashless economy. All the money stay in the bank as deposit. So that means holding cash also stops the process. Okay? So those are the main limitation of this model. So shortly, I'm going to talk about, we're going to relax those 2 assumptions. Assumption that the public hold no cash and the banks keep no excess reserve. We're going to allow for the possibility in a complete model to see what is going on. But before I do that, let's discuss the factors that affect the money supply, that determine money supply. So we talked about that already. One of them is changes in non-borrowed reserves that I talked about earlier on, like open market operation. When the Fed buys bonds, money supply increases. When the Fed sells bond, money supply is going to decrease. Because when they buy bonds, there's going to be an increase in the monetary base. An increase in the monetary base leads to an increase in money supply. Okay? So there's a positive correlation between the non-borrowed monetary base and money supply. There's also a positive correlation between changes in borrow reserves. If the Fed loans money to financial institutions, money supply is going to go up. If the Fed decreases loaning money to financial institutions, that's also going to decrease money supply. So both of these MBN and non-borrow reserves that I talked about in BR here are all positively correlated with what? With the money supply. But we don't stop there. Changes in the reserve requirement also affect, this is going to be negatively correlated with money supply because we said money supply M1 is a sum of currency plus deposit. So change in the money supply is going to be change in currency plus change in deposit. But where does deposit come from? Deposit is given as change in R, 1 over R. You know this formula. So if the Fed increases this little R, which is a required reserve ratio, because it's at the bottom, then that means the change in deposit is going to fall. And once the change in deposit in the banking system falls, if this guy falls here, money supply is going to fall. So there's a negative correlation between the reserve requirement ratio, deposit, and money supply. Okay? So if the Fed wants to increase money supply, they better decrease the reserve requirement ratio. That means the Fed is going to allow for the possibility of banks to increase the amount of loans they give out from every customer deposit. So the money supply and the required reserve ratio are negatively correlated. Next is, which we're going to be talking about, the excess reserves. If banks choose to hold too much excess reserve, this excess reserves means that the banks are just sitting on a ton of money. They're not loaning it out. Okay? So an increase in excess reserve will decrease the ability of banks to lend out funds, and therefore money supply is going to go down. So there's a negative correlation between when banks are holding more excess reserve, money supply falls. Negative correlation. If they hold less excess reserves, money supply increases. So that's also a negative correlation. Negative correlated. And then changes in the currency holdings is also negatively correlated with money supply. Why? If Americans go and withdraw all their money, most of their money from their bank accounts and bring it home, what do you think is going to happen? That means banks have got less money to lend out. That is going to reduce the money creation process. So money supply is going to fall with an increase in what? In currency holding by the public. If Americans leave most of their money in the bank as deposit, meaning that currency holding falls, money supply goes up because banks now will have enough money to lend out to trigger this money creation process. So we just talked about that. So we can summarize the 5 factors that affect the money supply just using this symbol. So we know there's a positive correlation between what? Non-borrow reserves and money supply. When non-borrow reserve increases, money supply increases, meaning that if this hard will take down, this hard will take down. They move in the opposite, same direction. But required reserve ratio is negatively correlated. Okay, if the Federal Reserve raises the required reserve ratio, they're basically decreasing their what? Or reducing the ability of banks to lend out funds. So money supply is going to fall. So they're inversely correlated. When this increases, it is out responding down. But borrow reserves in the banking system, if it increases, money supply increases. They're positively correlated. Excess reserves, negatively correlated. Cash holdings by the public, negatively correlated with money supply. So we just talked about that. That's kind of a summary of it. Okay, now, since we are saying that the simple deposit multiplier has limitation because it does not allow for the possibility of the public holding cash, and it doesn't allow for the possibility of banks holding excess reserves. We know those assumptions are not true in reality, and we economists, we don't go to bed too soon if our model cannot explain what is going on in the real world. Because this model is assuming that the public hold no cash. That's an assumption, but that doesn't match with reality. The Americans out there who hold a ton of cash. Okay, at least they hold some cash. Okay, keep some cash at home in their wallet, in their purses, whatever. Okay, and then it also says that the second assumption that banks hold no excess reserve. That's not true either. Many banks in the United States sit on a ton of excess reserves. So that means we need a model which allows for the possibility of the public holding some cash and banks holding onto some excess reserves. So that's what we're going to. So we're going to develop a complete model of the money creation process and derive the formula for the money multiplier. Okay. So we're going to define the money multiplier. So there's a connection between the monetary base, which is the liability side of the Federal Reserve balance sheet that we talked about. If this is a fair, remember, the monetary base is a liability side, which consists of currency plus reserves. Because currency and reserves go on the liability side. We talked about that already. There's a connection between that monetary base and the total money supply in circulation, like M1. So M here is the total money supply. And we're gonna restrict ourselves to M1. Because, you know, a much narrower definition of money. But we can do it for M2 as well. Derive, show the relationship. And then this little m, you see, this is capital M. This little m on the right-hand side here is what we're gonna be calling the money multiplier. We're gonna show you what that is. And then, of course, MB, you already know that that's a monetary base. So the first thing we're going to do, I'm going to define to you what the money multiplier is. Then we can talk about it on the other side. Okay, so let's do that. Now I want you to pay much attention here because we're going to be doing some math and deriving the formula for what? That money multiplier. Let's create some space here for me to write. It's all in a second. We'll get it done here real quick. Okay, so it's too many slides. Okay, that's fine. So what we're saying is that we're saying that little the money supply M equals to little m times the monetary base. And we call, so this little m is what we're calling the what? The money multiplier. Money multiplier is the ratio of money supply to the monetary base. Because if you divide both sides by MB here, you get little m equals to M over MB. M is capital M. This is lowercase m. The lowercase m is the money multiplier, but this is the total money supply, then multiplied by monetary base. So if I divide both sides by the monetary base, divide capital M, the total money supply, by monetary base, the money multiplier is going to be defined as a ratio of money supply to the monetary base. Or you can talk about it's going to be the number of times an initial change in the monetary base. Changes in the monetary base are primarily brought because of the Federal Reserve changing policy. Change in the monetary base multiplies itself to generate a change in the money supply. Okay. For example, if the Federal Reserve buys bonds, $50 million bond purchase, we've shown already in the balance sheet that reserves in the banking system will increase by $50 million, and the monetary base will also increase by $50 million. Okay. So when monetary base increases by $50 million and banks are lending these funds, this can create money. New money can go up to what? Money supply can change up to $250 million, 5 times as much. So the number of times monetary base multiplies, which is 5 times, is a money multiplier. So we want to derive that formula, but this formula this time now, this is now a complete model of the money supply. Is going to allow for the possibility of banks keeping some reserves and the public holding some cash. So I'm gonna do that. So these are a complete model of money creation process. Complete model of money creation allows for 2 things. One, the public can hold some cash. Public holding some cash. So because we want to develop a complete model which matches with reality, what we see in the real world, and then also allows for the what? For the banks keeping what? Some excess reserves. Remember, in a simple model, we shut these 2 channels down. Banks were not allowed to what? We assume that banks kept no excess reserves. So because of that, I'm going to have a side note here. I'm going to define some new variables here, which we're going to be using shortly. I'm going to define a new variable, little c, lowercase c, is going to be equal to its uppercase version divided by d. Okay, so c here that is a total currency in circulation or cash that the public is holding. So this is what we're going to be calling what? The currency deposit ratio. Is a proportion of money that Americans have at home or in their wallet, money that is circulating with the public that is outside the banking system, relative to what is in the bank, what is in the checkable deposit. So for example, if your family has $5,000 at home in cash and $10,000 in the bank, then the currency deposit ratio would be, you take 5,000 divided by 10,000, would be 1/2. Meaning that a half of what your family has in the bank is at home in cash. Okay, so if we do that, okay, so we say suppose C, if C is, let's do it, if C is $5,000 and D is say $10,000, then the currency deposit ratio, little c is big C over D, is going to be $5,000 divided by $10,000. Dollar sign cancel, so this is going to be 1/2. So the interpretation is that a half of what your family has at home in terms of currency holding is in the bank. Okay, and then from there, we're also going to define another variable, 2 variables. The second variable, because now this variable here is going to allow for the possibility of Americans holding some cash. Remember, in a simple model, this was 0. This big C was 0. So there was no such a variable as currency deposit ratio because C was 0. We assumed that American held no cash. That was assumption of a simple model. But now we're allowing for the possibility of some cash holdings. Then the second side note, I'm going to define a new variable, which I'm going to call little e, which is going to be defined as excess reserve divided by deposit. So we're going to call this new variable the excess reserve deposit ratio. Is the amount of the money that the banks are keeping in excess reserves, okay, as you know, as a proportion of the total deposit in the banking system. So for example, if the size of deposit was $10,000 and banks are keeping $1,000 in excess reserves, Then the excess reserve ratio, little e, you take the total excess reserve divided by deposit, which in this case is going to be $1,000 divided by $10,000. So your excess reserve ratio, little e, would be 0.1 here. 1 divided by 10 is 0.1. Okay, so now let's do a little bit of some manipulation. So now, since we know that little c equals to big C, is uppercase version over deposit. If we cross multiply, okay, then we cross multiply. That means big C is gonna be equal to little c times D. So I wanted to call this like star, like equation star. We're gonna use this. And then also, we also know that we have just defined that little e equals to ER, excess reserve divided by deposit, the excess reserve deposit ratio. So if I cross multiply, that means big ER is going to be equal to little e times D. Also put this aside. We're going to use this. Star, star. Okay? So now, let's define our monetary base. As before, we know the monetary base is a liability side of the Federal Reserve balance sheet. It's given as currency in circulation plus reserves. I want you to follow step by step because I'm deriving. So now what we're going to say, let me actually open a new side. We just say we deriving the money multiplier, the formula for the money multiplier, that little m. Okay, so we began by saying money supply m equals to little m times the monetary base. We want to see whether this is actually true. There's a connection between money supply and monetary base using money supply in circulation equals to money multiplier lowercase m times the monetary base. But we know that the monetary base is given as currency plus reserves. That's the liability side of the Fed's balance sheet. And then also we know that what? Total reserves, which is this R here, can be split into required reserves. Remember, we did this, plus excess reserves. You know that is true for you from chapter 9. Okay? And how do we figure out the minimum reserve, the minimum reserve that the Fed wants every bank to keep? So reserve requirement, the little R, it's a big R, you take the required reserve ratio times deposit. We know that is also true. Then therefore, your total reserves then can be written as, where there is RR, we're going to substitute, replace it with this because reserve ratio is reserve requirement, you take the required reserve ratio times deposit. So we're going to substitute this guy here for RR. Then this equation becomes R equals to, instead of RR, we replace that with R times D plus excess reserve. Okay? So if you name this equation 1 and you name this equation 2, we're going to say substitute equation 2 in 1 for R. Meaning that we're going to substitute the right-hand side of equation 2 is going to be substituted here because that is R. Then equation 1 is going to become, the monetary base is going to be written as total currency in circulation plus, where there's total reserves, we're going to replace it with the right-hand side of equation 2, which is going to be R times D plus the excess reserve ratio. Okay? So we're making good progress. Now, you can see, so let's go back here. So, but we know that what? Remember our side note. Our side note says that what? Big C equals to C, little CD. And big ER equals to little ED. So let's go back there and try to use that side note. But we know that one. We know that little big C is given as little c times D. And we know that ER is given as little e times D. You multiply the excess reserve deposit ratio times deposit. That's going to be your excess result. Then we're going to substitute those here. So where there's big C, we're going to substitute it with little c times D. Where there's big ER, we substitute E times D. So then the monetary base is going to be written as where there's this C, that's going to be the same thing as little c times D plus RD plus ER is going to be little e times D. Okay? So we can name this equation 3. Okay, like we're making progress. So equation 3 is now saying that monetary base is given as little c times D plus little r times D plus little e times D. That's what equation 3 is. Now you realize now that what you're going to realize here is that, let me see here. Where's my slide? Says Spain about today. Must have deleted something. Okay, it did not. Okay, pull up to the next. Okay, let me delete that. Okay, there you go. So now you can see on the right-hand side, D is common. D is common on the right-hand side. We can factor that out. Okay. So this become then monetary base. You can write this as monetary base. Since D is common, you can factor that out. It's going to be D inside C plus R plus E. Nice. Okay, then we can make D the subject. Okay, so you can say divide both sides. Dividing both sides. An equation, what you have done on the left, you must do on the right, by C plus R plus E. So if we do that, you're going to get the left-hand side is going to be 1 over C plus R plus E times the monetary base must equal to D. Because if you divide both sides by D here, by C plus R, this is going to cancel. You brought this C down here. So it's going to be MB divided by C plus R plus E, which you can write as 1 over C plus R plus E times MB. So we found that D can be written that the total deposit in a banking system is the same thing as 1 over C plus R plus E. That's what we just found. Multiplied by the monetary base. You call this equation 4. Keep that. And then let's go and find what is the formula for money supply M1. So we know that M1 is given as currency in circulation plus deposit. We know it in the chapter 3, I showed that you also add traveler's checks, but traveler's checks have become a negligible component of M1. Nobody uses traveler's checks anymore. It used to be very popular when we did not have international traveling card like MasterCard, Visa, and MasterCards in the 1970s, 1960s. People used to carry a ton of traveler's checks. Okay? Oh, but now we know that one. We also know that this big C from our side node is the same thing as little c times D. So that means the money supply M1. So where there's big C here, I'm going to replace it with this what? Currency deposit ratio times deposit. So that's become little c times D plus D. Now you can see D is common. So that means my M1 is going to be equals to D inside 1 plus C. And again, dividing both sides of this last expression by 1 plus C is going to yield D equals to 1 over 1 plus C times M1. So we can call this equation 5. Okay, so remember, what is equation 4? That's equation 4. That is relating deposit and monetary base. Equation 5 is relating deposit and money supply. So we can combine those two. So we know equation 4, we just found that one. We found that D equals to 1 over C plus R plus E multiplied by the monetary base. This was our equation 4, remember? And we just derived equation 5 that D equals to 1 over 1 plus C times the money supply M1. This is equation 5. So now if D equals to the right-hand side and D equals to the right-hand side here, we can set the right-hand side equal because that's the same D. Set right-hand sides equal of equation 4 and 5. Because it's the same D equals to that, then the same D equals to this, then that means the right-hand side of these two equations must be the same. So if that is true, then that means 1 over 1 plus C times the money supply M1 is going to be equal to the right-hand side of equation 4, which is 1 over C plus R plus E times the monetary base. Okay? Then we are done. Then we can now, so multiply both sides by 1 plus C. So if you multiply both sides by 1 plus C, left-hand side is just going to be M1. Because if I multiply here by 1 plus C, the 1 plus C is going to cancel. It only remain with M1. If I multiply right-hand side by 1 plus C, right-hand side is going to be, that 1 plus C is going to become the numerator. So it's going to be 1 plus little c. These are lowercase c. These are all lowercase variables here on the right. You know, these things here that I put in bracket, they're all lowercase variables multiplied by the monetary base. This is the relationship between monetary base and money supply. Now, this is a complete model of money supply. I'm going to talk about it. I want you to pay much attention now. So we have found out that, and you don't have to write M1, you can, because we know that's money supply M1, the narrowest definition of money. We can just now say M, which is a total money supply, equals to 1 plus C, little c, divided by C plus R plus E times the monetary base. So compare this equation with, compare it with where we started from. Compare it with, we say that the relation money supply M was equal to little m times the monetary base. If you compare these two equations, remember, this is your monetary base matches with that monetary base. This is your money supply here matches with this money supply. Meaning that this guy here, these little variables here, 1 plus C divided by C plus R plus E, that is going to be your money multiplier. So therefore, the money multiplier is given as, which is a little m, it's 1 plus C over C plus R plus E. Very important. So if I ask you a question on the test, we're going to do an example. If I ask you a question, calculate the current, the money multiplier. You're going to say 1 plus the currency deposit ratio. You must know it, or you might solve it in the problem. That's the same C here, currency deposit ratio, which is big C over D. This is a reserve ratio, which is R over D. This is an excess reserve ratio. Okay. Okay, so now I want us to summarize this equation, and I'm going to explain what they mean. So first of all, we found the first equation says M equals to little m times MB. That's where we started from. You multiply that. And you can express it as change, or you can write this as change in what? In M equals, so this M is fixed. It's like a constant. It's going to be little m times the change in the monetary base. If you express this equation in terms of change, you're going to have like that. And then we also found that M equals to 1 plus C over C plus R plus E multiplied by the monetary base. You also need to remember that, because sometimes I might bring you questions in different versions. Okay, and then therefore, the money multiplier little m is going to be the 1 plus C over C plus R plus E. Okay, so now this model this is a complete model of money supply. This is a complete model of money supply. Why? This model allows for the possibility of Americans keeping cash, which is captured by this little c, because that little c is a currency deposit ratio. Remember, little c is big C over D. And the model also allows for banks to hold some excess reserve. So this little e captures the decision by banks, which is x0 or deposit. This little r, that is the required reserve deposit ratio. You can write it as RR divided by deposit. So all these three variables. Okay, so now I want to ask you, so when we started this lecture, the first slide was that the money supply is not controlled by the Fed alone. There are three players in the money creation process. Banks have an influence. If banks choose to keep too much excess reserve, look at that. Because keeping too much excess reserve, because this little variable 1 plus C was C plus R plus E is a what? Is a money multiplier. If there's if excess reserve is high, this ratio here is going to be small, meaning that the money supply is going to be affected, because the money supply depends on the money multiplier, and the money multiplier comprises of the excess reserve. So there's a negative relationship between excess reserve ratio and the money supply. If banks choose to keep too much excess reserve, this big ER, that means this little e is going to increase, and that means the money supply is going to fall. And the converse is true. If banks decrease their holding of excess reserve, meaning ER is small, this ratio is going to go down. That means little e goes down. Because E is at the bottom, this ratio is going to fall. So that means money supply will fall. So a decrease in the excess reserve ratio is going to increase the money multiplier. So that meant to say that money supply. But an increase in E is going to decrease the money supply. Negative relationship. Who is the other player in the money creation process that we talked about? Americans, depositors. American households are represented by this C over D. The decisions to hold money in the United States depends on the family. A matter of fact, if your family has $10 million in a bank account, if they choose to go and withdraw all the money and keep it in the house, nobody cares in the United States. There's no law in America, as far as I'm concerned, which restrict how much money you keep at home and how much you keep at the bank. It's your family's decision. Okay, but we know that if Americans go and withdraw too much money in general and keep it at home, that is going to reduce the capability of banks giving out loans, because there's not enough money left in the banking system. Banks will not have enough money left to loan out. So that is going to curtail the money creation process. So you get the logic now. Okay, so now the idea is, so even though you see these C's both at the top, at the numerator and denominator, because it's addition, 1 plus C divided by C plus R plus E. Somebody might say, oh, if I increase little c, because they're both at the bottom and the numerator, they cannot cancel, because it's 1 plus c. It's not a product of two things. So this can, but if you increase it, you can try during your free time. Well, I'm going to do an example. If you choose a smaller c, let's say c was 0.3, and then you increase c to like 0.5, meaning that the currency deposit ratio is going up, you're going to see that after increasing little c, the money supply is going to fall, or the money multiplier is going to fall. When the money multiplier falls, then M is going to fall. That's the logic. Okay, remember, when we teach you principles macro, we also say that there were three tools of monetary policy which the Federal Reserve uses to control the money supply and the deposit creation process and reserves in the banking system as well. We discussed the first two earlier on. We said buying and selling of treasury bonds. Buying and selling of treasury bonds affect the monetary base. We did that with the balance sheet. And then loaning money to financial institutions also affect the monetary base. So when you increase if you want to increase the money supply using those two tools, you either loan money to banks, because if you loan money to banks, reserves in the banking system is going to go up and the monetary base is going to go up. So the money supply is going to go up. Okay? If you buy bonds, monetary base goes up because reserves go up in the banking system. We did that with the balance sheet. Money supply is going to go up. But there's another tool of monetary policy which does not affect the monetary base, but it affects the money multiplier. And that is this little R here. The Federal Reserve regulates banks by setting the reserve requirement ratio. We even saw that in chapter 9. This little result, a little odd. The Fed is going to say that a fraction of customers' deposit must not be loaned out. It could be set at 10%. So if and they audit all banks in America every 2 weeks. So if Bank of America received $10 billion in total deposit after 2 weeks, by law they should keep $1 billion in what? In required reserves with the Fed. And that money must be deposited with the Fed. Meaning that if the Federal Reserve increases the reserve requirement ratio, they wake up tomorrow and we say, oh, the Fed has raised the reserve, wants now banks to keep 20% of customer deposit instead of 10. Because the required reserve ratio is at the bottom, if you increase it, that means that's going to decrease the money multiplier. And the money supply is going to go down. So there are three main tools of monetary policy that the Fed uses to control the money supply: lending money to financial institutions and charging discount loans, open market operation, which is buying and selling of treasury bonds. Those first two affect the monetary base, affect the money supply through their influence on the monetary base. But the third monetary policy tool, which is the reserve requirement, the required reserve ratio that the Fed sets for bank to follow, that does not affect the monetary base. Yes, it's going to affect the money supply through the money multiplier. So when you understand that very well, the reserve requirement ratio affects the money multiplier, not the monetary base. But it ends up affecting money supply in the end as well. So now you have seen that it's not only the Federal Reserve that can influence money supply process in the economy. There are three main players. I'm going to repeat that over and over. The Federal Reserve is going to influence that for the most part, because the Fed can influence monetary base through bond purchase and bond sale, or through lending money to financial institutions. That's how they influence money, which will have an impact on money supply on the left. And the Fed also has an influence on the required reserve ratio. They're the one who said it. But don't discount the actions of American households or American depositors who are depositing money in the banks. If Americans decide to deposit less money at the bank, meaning that they withdraw all their monies and keep them at home, then that is going to reduce the money multiplier, and the impact on money supply is going to be a fall in the money supply. Or when banks decide to keep too much of excess reserve, that means the excess reserve deposit ratio, the little e, goes up. That's going to directly impact, the money multiplier is going to fall in that case, and the money supply is going to fall. So now you've done that. So three players are very important: depositors, financial institutions like banks, and the Federal Reserve. They all play a role in the money creation process. But the Fed, of course, has a much bigger role in terms of controlling the money supply, because the Fed has a lot more tools. You can see there are two other things that go into monetary base, like loaning money to financial institutions or buying and selling bonds. All those are done by the Fed, not the public or whatever, or banks. And then the Fed also controls. So the Fed controls many things on this in this model, which influence money supply. But don't discount the actions by banks and actions by American families as well, or the American households who are depositing money in the bank, and corporations. Okay, so that is so when you go to your slide now, those are the things that because we are deriving the money multiplier. So we created this side note. So we started here by saying that like that. Then we created this side note, but I already derived them. So you can go follow to the we call this, the little c was a currency deposit ratio. You can just call it a currency ratio, but I like to call it in the full. You in full you call it the currency deposit ratio. That's the way we're calling it. Then for short, you can just call it this one excess reserve ratio, but I like to call it as excess reserve dash deposit ratio. You can just call it excess what? The excess reserve ratio. So that's what we did. And then we did a little bit of, we cross multiply. If little c equals to big C over D, we cross multiply. So that means big C is going to be equals to little c times D. And then if little e, excess reserve ratio, equals to ER over D, if you cross multiply this, that means the ER is going to be equals, we did this, equals like that. And then we went to work. We say that the total reserves in the banking system equals the required reserves and plus excess reserve. But required reserve is given as is a fraction of the required. You take the required reserve ratio times deposit. So if we substitute this equation back here, you get total reserve equals to required reserve, which is written like that, plus excess reserve. The Fed sets that R to be less than 1. That's the excess reserve ratio. And then we wrote the formula for the monetary base. Remember, we first started, we said the monetary base equals to currency plus reserves. Now we saw, now that's going to be equals to currency plus reserves, but reserves are this guy. We're substituting this guy here because that's what reserve is. That's what we did. So C plus this times the plus that. Okay? And then we now use our side note. Little e equals to E over D, which is C equals to C. Now see that? Substitute, we get D, then we factor out D. So I might have skipped a certain steps here. Then we found D equals to 1 over R plus E plus C. The order doesn't matter. We were writing C plus R plus E because you're adding C plus R and little C plus. You can start by E. You can start by writing R because you're adding them up. When you say 2 plus 3 equals to 3 plus 2, it doesn't really matter which one you start writing. And then the formula for money supply M1 is currency in circulation plus deposit. And then also we apply, we know little c equals to big C equals to little c times D. Then we do that. Then we found this. Okay. Then we combine this equation with this. If you make D the subject here, we say D was what? Was going to be equals to 1 over 1 plus C times the money supply. And then you can compare that with this equation here. This also D. Then we set the right-hand side of those equations equal. Once we did that, we found this formula here. And the money multiplier is going to be this guy. That's exactly what we found up here. Yes. Found that. The money multiplier is this. Okay. So let's do a simple example here. The intuition behind the money multiplier. So let's say if R is a required reserve ratio is 10%, 10 they're given in decimal, that's 10%. The Fed sets a 10% required reserve ratio. And the currency in circulation, just a simple example, is $400 billion. And checkable deposit was $800 billion. And excess reserve was 0.8 of $1 billion. Then if I ask you to calculate the money supply, you just add them up. Money supply M1 is just going to be C plus D. We've been given currency 400 billion plus deposit 800 billion. So this is easy. So money supply would be $1,200 billion. That's what you're seeing here. And then I asked you to calculate the currency deposit ratio, which is a little c. We know that little c is given as big C over D. We did that, which is going to be big C is $400 billion divided by 800 billion. So that's going to be 1/2 or 0.5. That's what you see here. Excess reserve deposit ratio, you take total excess reserve because this is your big ER. Okay, so you take the so little e in the memory is equals to big ER over D. So big ER is 0.8 over billion divided by 800. That's going to be 0.001. And then the money multiplier, which we say the money multiplier equals to 1 plus C divided by R plus E plus C. So 1 plus C is 0.5. You already solve for it here. You just plug it in here. So that's a 1 plus 0.5 divided by the denominator 0.1. The R is given here. So that's just going to be 0.1 plus the excess reserve ratio, which you just solve it here is 0.01. Then plus 0.5, which is the same C here. So that gives you the what? The money multiplier to be 2.5. So what is the interpretation of this 2.5? The interpretation of 2.5 is that if the Federal Reserve increases the monetary base, let's say through bond purchase, if they bought a $1 bond purchase, remember, leads to an increase in the monetary base of $1. Monetary base is going to increase by the same amount of the bond purchase. We saw that already. So if the monetary base increases by $1, then the money supply is going to increase by $2.5, by 2.5 times as much. So every $1 increase in the monetary base as a result of the Federal Reserve monetary policy action is going to lead to a $2.5 increase in the money supply. That's how you interpret this number. Because the money multiplier is the number of times a change in the monetary base due to the Federal Reserve monetary policy action, such as buying bonds, will lead to a change in the money supply. So for every $1 of bond purchase leads to a $2.5 increase in new money. Then what about if the Fed buys $100 million worth of bonds? If for every $1 leads to $2.5 new dollars, that means $100 million bond purchase is going to lead to $250 million increase in money supply. So, you get to see the logic. So I want to do a formal example here. Then we can talk about it. You're going to encounter this also on the test with this complete model. So this is a complete model of the money supply. But let's do one example to clear up our understanding more even on this. So example on this. Okay. We can say, suppose the Fed purchased $40 billion of securities from banks. Okay. So Roman 1, I'm going to say, part A, show the impact of this bond purchase on reserves and the monetary base. Okay. Do that. And then 2, Roman 2, we're going to say, part B, we're going to say if the money multiplier is 2.5, let's say it's 3.5. Okay. What would be the change in money supply as a result of this bond purchase? Okay. So let's go do that. So part A of the problem says we need to, you're already accustomed to this. The Federal Reserve purchase $100 million. So we want to see what they're purchasing this from banks, banking system. Federal Reserve. Okay, so the Fed bought $40 million. If you buy something, you gain it. You know the drills. So the Fed is gonna gain $40 billion. But they're buying this from banks, so banks are gonna see their securities or their bonds, because banks are the ones selling, so they will see their securities go down by $40 billion. But the banks are going to be credited with a reserve. Their reserve account is going to go up. The Fed is going to credit them with a $40 billion reserve. While reserves are bank assets, that the Federal Reserve liabilities go on the right-hand side of the balance sheet. It's going to be plus $40 billion there. So in this case, the change in reserves, as we have been asked, is $40 billion. The change in the monetary base, which is given as change in currency plus change in reserves, it's the reserve component that changed by $40 billion. So the change in the monetary base equals to $40 billion. Very simple. Okay. And then run part B, we have been told that if the little m is 2.5, that's the money multiplier. What will be the change in the money supply? We know that money supply, there's a relationship between money supply and the monetary base, written as little m times MB. If I did not give you the money multiplier, that means I would give you information on total currency in circulation and deposit. So you would what? Because this can be calculated if its value is not given. The formula is given as what? 1 plus C divided by R plus E plus C. So that means I would have given you information that allows you to get this little c, little e, and little r. Then you solve it. But I already given you, I already calculated that. I said this is what? 2.5. So from part A, we know. So now we can write this as m equals to little m times. No, I'm writing in terms of change. So delta m equals to little m times change in MB. Remember, little m is a fixed number. So this is like, when you say m equals to little m times MB, it's like somebody writing equation y equals to 2x. Because remember, these are fixed variables. The currency deposit ratio is a constant. Americans save a certain fraction of their, keep a certain fraction of their deposit at home as currency. And then the Federal Reserve sets a fixed ratio for banks to fall as required reserves. Banks are also keeping a fixed proportion of their deposit in excess reserve. So because everything is a constant, that m is gonna be a constant as well. So m is like 2. So if you want to get change in y, for example, in this equation, you write it as 2 change in x. That's the same thing here. Since m is a constant, I can write this as delta m, or change in m, must equal to little m times change in what? M times b. But we found that from part A, we know that the change in the monetary base from this bond purchase was $40 billion. So therefore, the money supply here is going to increase by 2.5 times, because m is 2.5, times 40 billion. So you do the math. That's going to be equals to what? 120, no, 2.5, 80, then 0.5 times, that's going to be 100 million. So we're using billion or million? I'm not sure. I think we're using billion, so this is billion. Okay, so 100 billion is going to be the change in the money supply. So that's how you solve it. Let's do a little bit of case studies. So when the global financial crisis began in the fall of 2007, we talked about the financial crisis last time, chapter 12. The Fed initiated lending programs and large-scale asset purchase. The Federal Reserve came up with a bunch of unconventional tools of monetary policy. Okay, so here's what you need to know. During 2007, typically when the Federal Reserve has to intervene in the economy, let's say when the economy goes to a recession, the Fed always lowers interest rate to keep the economy strong. But the recession of 2007 was very unique. It poses what we call a zero lower bound problem on interest rate. Why? When that recession hit, the interest rates were almost close to their zero lower bound level, close to zero. So the question then was, the Fed could not lower interest rate and make them negative. Because we learned from the Japanese experience of the 1990s. If you hear economists and politicians talking about the Japanese lost decade of the 1990s, what are they talking about? In 1990, the economy of Japan was weak, so the Central Bank of Japan started lowering interest rate to keep the economy of Japan strong. And they kept lowering interest rate, and interest rates became negative. So you end up with what we call in macroeconomics a liquidity trap. The liquidity trap is when interest rates become negative. It brings problems. People don't want to save, because if you save money, you get paid negative interest rate. Okay, and then so when you're borrowing money, that means you pay less than what they gave you. Because if interest rates are negative, let's say negative 10%, like in Japan in 90, if I borrowed 10,000 yen at that time in Tokyo, I would pay back like, say what, $9,000, because 10% negative interest rate. Negative 1,000 would be the interest rate that I should pay on that loan. So negative 1,000 plus what I borrowed. You think any cent bank is going to give you a loan if you have to pay them less than what they gave you? So what happened when interest rate in Japan became negative, the Japanese banks refused to lend. And the Japanese economy fell because if banks cannot lend to the economy, businesses could not get loans in Japan. The Japanese households could not borrow money for consumption on consumption loans, stuff like that. That translated into a weak economy. So the Japanese economy experienced negative economic growth throughout the 1990s. So when economists are talking about the Japanese lost decade of the 90s, we are referring to that Japanese experience when interest rate became negative and that translated into what? Low economic growth. So we did not want to go back to that playbook. We learned already from a Japanese experience. So when the financial crisis hit in 2007, we should thank Ben Bernanke. I call him Big Ben. Ben Bernanke was the chair of the Federal Reserve at that time. Okay? So Ben Bernanke had to come up with some unconventional tools because the conventional tools of monetary policy that the Fed has always used weren't working. Because all those three tools that we discussed before, if the economy is weak, they are geared to lowering interest rate. But you cannot now stimulate the economy through low interest rate when interest rates are already near zero. So the Fed then started this new asset program, what they call quantitative easing. So quantitative easing is basically because the idea was that banks on Wall Street had invested in these mortgage-backed securities, which started from housing market. We talked about mortgage-backed securities. And when Americans started to default on their mortgages, those mortgage-backed securities, the values almost went to zero. So banks were holding a bunch of toxic assets on their Wall Street banks. So to show up liquidity in American banking, the Fed went and bought those toxic assets of Wall Street. Okay, so that's what we call large asset purchase by the Fed. It's like an unconventional tool of monetary policy. They never used that before. The Fed spent nearly $4 trillion to bail out Wall Street banks. Okay, that's what we call quantitative easing. There are some other measures that the Fed, other unconventional tools that they use, things that were never tried before. For example, there's what they call operational twist. Operation twist. Okay, and then there's another one which basically swapping in long-term interest rate for short-term interest rate. Okay, to show up the values of long-term assets like housing. And then the other thing that they did was credit swaps with other central banks around the world because America was falling during the financial crisis in a big recession, and that translated into a global recession. So the idea was that even if the Fed had to stimulate the U.S. economy, if the U.S. economy were to recover first, and other countries that we trade with, our trading partners don't recover at the same time, then America would be collecting water with a basket. That's not good. So to make other economies that are not capable for stimulating the economies, especially our trading partners, recover at the same time, the Federal Reserve coordinated with other central banks around the world and was lending them funds so that those central banks can then use the money that the Fed gave them to lend to the economies, to banks within the economies, so that the global economy will recover at the same time. We call those credit swaps. Another case called swapping credit. Credit swaps with other central banks. So there were a variety of many other conventions. Then the Fed started what they call term auction facility. They were auctioning credit to American banks which are in liquidity crisis. They opened up several, discount window lending programs so that banks that were having liquidity problems could access credit more easily than the traditional way that they normally access through the Fed. So they basically broaden ways that banks could easily borrow money from the Fed so that they could recover. Because banks were collapsing in America. So during the pandemic, during the coronavirus, the COVID, the Federal Reserve again engaged in massive quantitative easing programs to prevent a collapse of the economy. They went because if we shut down the economy, banks were not doing any business because most businesses were shut down. Some banks started to suffer losses on their balance sheet. So the Fed also went and injected more liquidity into these banks by purchasing some of their toxic assets off their balance sheet. So this is what happened. Look, this is exactly what I was telling you. So when the financial crisis hit how do you know that the Fed is intervening? But when the Fed is buying us, because anytime the Fed buys something from banks, whether bonds, whether any toxic asset, any other securities from a bank balance sheet, monetary base should go up. The money, so you see the amount by which the Fed has spent buying assets on from banks would be represented by how much monetary base has changed. Okay? So look, the monetary base is a black line. Before the financial crisis hit, the total monetary base, the monetary liabilities of the Fed was a little bit under 1 trillion because these numbers are in billions of dollars. So 1,000 billion, that is 1 trillion. So you see, it was about $900 billion. Now look, so the Fed went and bought these toxic assets. Look at how the monetary base has been rising, and now combined with what happened during COVID. So now the monetary base of the Fed show up to what? $5 trillion. That's what I told you. So the Fed basically bought assets worth $4 trillion. That's how much they used to bail out banks that were collapsing. And the money supply also increased sharply. See that? M1 went up a lot throughout the financial crisis and connected to COVID. Because there's a connection between money supply, you know that, and we just talked about a little M times MB. If you buy assets from bank, that's affect the monetary base and money supply is gonna go up. So that's exactly the red line is the money supply M1. Okay, I want to talk about something here which is interesting. So this is when you look at the currency ratio, during the financial crisis and during COVID did not decrease that much. It changed, did not, it actually almost decreased again. I would say it stayed almost flat. It's not a sharp decrease. Why? So even though banks were failing in 2007, 2009, we have what we call now FDIC, which I talked about in chapter 9. FDIC stands for the Federal Deposit Insurance Corporation. So federal program, Federal Deposit Insurance Corporation. So it's an agency of the US government which partners with banks. That all your deposit, if you deposit money into your bank account, those deposits are insured by the federal government through the FDIC. Up to $250,000 on individual account. So if, let's say, your bank were to go bankrupt and you had money into your bank account up to $250,000, let's say you had $200,000 in your bank account, you would get that money back. The federal government would compensate you because all our deposits are insured. So but when you go back to the Great Depression, I'm sorry I did not bring the stuff for the Great Depression here. The currency deposit, this currency ratio, because just a currency deposit ratio, which is little c, big C over D, which we talked about. During the Great Depression, it looked like that, it goes like that, increased sharply. Why? Because during the Great Depression happened between 1929 to 1933. We did not have the FDIC yet. The FDIC was created in 1934 when President FDR became president. Okay? Franklin Delano Roosevelt became president in 1934 after he succeeded Albert Hoover. So Albert Hoover was the president of the United States during the Great Depression, 1929 to 1933. During that time, there was no FDIC. So that means if a bank were to fail, you will lose all your money. That was the reality. That's the reason why more than 4,000 banks failed in the United States during the Great Depression, almost a total collapse of the financial system in America during the Great Depression. Because what does that mean? And we saw the currency ratio shooting. And why did banks fail? So because Americans knew that if their bank were to fail, their deposit were not insured because there was no FDIC between 1929 and 1933. So if I saw a bank failing in my neighborhood or in my hometown, my interpretation would be that mine was next. I become worried. So most Americans decided to go, when they see a bank failing, they will rush to their banks, try to withdraw all their money. Let me tell you one thing. If we all show up at our bank location on a single day wanting to withdraw all our money, the banks would fail. Banks rely so much on customer deposits. So because most Americans withdrew all their money because they were worried, this big C up here increased. They were turning deposit into currency. So the numerator was increasing and the denominator was decreasing, meaning that the little c, which is a currency deposit ratio, shot up sharply. If I had a graph for the Great Depression, you're going to see it went up a lot during the Great Depression. But in contemporary times, the currency deposit ratio does not go up. Americans don't withdraw money from their banks fearing that their banks are going to fail because they know Americans don't have chips on their shoulders. They know if their banks were to fail, no big deal. Their deposits are insured, FDIC insured. So nobody panics to go withdraw all their monies in contemporary times. But that wasn't the case during the Great Depression. Okay, that's why you're seeing even the currency deposit ratio kind of like what is not a shot, actually decline a little bit, but it almost like no trend at all. What changed a lot was the excess reserve deposit ratio. See, so during the financial crisis, look at how the excess reserve deposit ratio went up. Because the economy became risky, we went to a terrible recession. You think any bank out there is going to loan a lot of money in a weak economy? When there's a lot of joblessness, high unemployment, many companies are shutting down. Banks are going to sit on their excess reserves when the economy is weak. They fear lending money because of high credit risk. That's why you're seeing the excess reserve ratio shot up a lot during the Great Depression. No, not the Great Depression. During the financial crisis of 2007, 2009. I'm making this up here. Okay. Because banks were worried that, if they loan out money, people may not pay back in a weak economy. So while the currency ratio did not change that much, the excess reserve deposit ratio went up a lot during the Great Depression. So I don't know why I kept saying during the Great Depression. During the Great Depression, it went up to during the recent financial crisis. It shot up a lot. So that is the end of this chapter. So it's a fairly long chapter. It has two parts. The first part, I talked a lot about things there too. Then now this is just to complete show you the complete model of the money supply or the money creation process. So I'm going to upload the videos for this chapter. Make sure you watch this video because there's a lot of information here. We talked about the balance sheet of the Federal Reserve. We did some balance sheet entries. We talked about more policy tools, but how it affects the balance sheet. We went step by step. And then up to we talked about the simple deposit creation process. We talked about the limitation of that. That's why we ended up with this complete model of the money supply, which allows for the possibility of banks keeping some excess reserve and the public holding some cash. So right now, you have learned monetary policy in two ways. You can, when I ask you a question on the test that show how you can use mathematical modeling, like these equations, to show what happens to money supply when the Fed buys or sells bonds, when the Fed implements monetary policy. You also know the balance sheet approach. When the Fed buys bond, how does that affect elements on the balance sheet? So in the next chapter, I'm going to use geometry, okay, to show you how monetary policy implemented. So you're going to have three ways to understand how Federal Reserve or the central bank influence interest rate and the supply of dollars in the economy. Right now, you have understood it using two ways, using balance sheet approach and using this simple model of money creation process. So in the next chapter, we're going to talk about it using geometry. When I say geometry, I mean using supply and demand. We're going to talk about the supply and demand for reserves in the banking system. We're going to draw the supply curve for reserves and the demand for reserves, and we show how monetary policy actions by the Fed, like buying bonds, will affect the equilibrium federal funds rate, or this interest rate that the Federal Reserve controls. Okay, so now you're going to have three ways of knowing how the Fed controls the money supply and interest rate in the economy. Anyway, next time, see you later. Bye-bye.